Hello everyone, thanks for checking out my video. Before I begin, I thought to inform you that I will be busy next weekend, therefore there will be no video next week, but I will be back the following week. Alright, the US stock market closed in the sea of red last Friday with S&P 500 clocking its worst week since March 2023 and Nasdaq registering its poorest weekly performance since early 2022. The entire Magnificent Seven was sold off by the market. Notably, Nvidia and Alphabet were down 4% and Tesla plunged more than 8%. The market is now calling for Jerome Powell to get those scissors ready for some rate cuts before something in the economy cracks. And just so you know, since the stock market opened for trading this September, we haven't had a single green day. In the process, trillions of dollars have been wiped out from the stock market. What a massacre. With the election and Fed rate cuts coming, we have to brace for more volatility. Alright, let's discuss more of this in this video. So as usual, do stay throughout to not miss a thing. Alright, September did not start on a good note. On its first trading day, the hottest stock in town, Nvidia, plummeted 9.5%, erasing close to $280 billion of market cap in the process. The decline has broken the record for the largest single-day decline in market value for a US company. By the end of the week, Nvidia had wiped out more than $400 billion in value. Combined with the other Magnificent Seven stocks, this group of tech giants has now lost more than $500 billion of market cap last week. And if we look at the broader market, S&P 500 has erased $2.2 trillion of market cap in the first week of September. So what exactly caused this major sell-off last week? It started off with a weak manufacturing data that was released last Tuesday, 3rd September. The index rose 47.2% in August, which is below the forecast of 47.9%. This data translates to manufacturing activities are slowing down, which prompted the fears about a weakening US economy. On that day, the market sold off, with S&P 500 falling more than 2% and the tech-heavy Nasdaq dropping over 3%. And just when we thought that day was bad, then came Friday's jobs report. The latest data showed US added 142,000 jobs in August, which is lower than analysts' expectations of 164,000. But the unemployment rate was 4.2%, in line with expectations and lower than the prior month. However, to the market and investors, while unemployment rate is back on the decline, the labor market is showing signs of weakness and cracking. In fact, some argued that what actually worried investors is the big downward revision to the previous jobs data. For July, it was previously reported as 114,000 jobs added, and this number was revised to just 89,000 jobs. That is a downward revision of 25,000 jobs. In total, June and July were revised down by a combined of 86,000 jobs. If you don't know what all this means, let me summarize the key takeaway for you. And that is, this weak non-farm payrolls report is adding to the existing evidence of a slowing labor market, which got people worrying about the health of US economy. Worrying as in, are companies gonna stop hiring? Will more people lose their jobs? Will consumers start cutting back on their spendings? Will all this trigger a recession? This is why many investors are dumping risky assets, especially the high-growth tech stocks. Looking ahead, it is going to be another busy week on the Wall Street, with investors' attention shifting to the latest inflation data. On Thursday, 12 September, we will have the Producer Price Index, aka PPI data coming out. Then on Friday, 13 September, we will have the Consumer Price Index, aka CPI data. On the very same day, investors will also receive the preliminary results of Michigan consumer sentiment. We will get to see how consumers are feeling about the current economy, and with the presidential election coming up, it could shake up some consumer sentiment. Throughout the week, some other notable events include Monday's Apple's event, Tuesday's presidential debates, and Thursday's initial jobless claims. And since I will be away for the following week, just to add, watch out for the FOMC meeting happening on 17 and 18 September. This is the meeting where Jerome Powell will be getting his scissors ready for the first rate cut since 2020. The biggest question that the market has in mind right now is, how much will the Fed cut? Well, we had the latest job report, and I think the upcoming inflation report could help to clarify that decision. Moving over to the technical analysis segment, with the market being so volatile and potentially bearish, I would say technical analysis is quite important during this period, especially if I want to pick up shares or trade some options. So do pay a bit more attention to this section. Anyway, things ain't looking that great for the overall broader market. It seems to me that a bearish double top pattern is forming. This is further supported by a bearish divergence on the RSI, a bearish MACD cross last week, and a sell-off with volume on Friday. Okay, not trying to scare you, but if the bearish double top plays out, theoretically speaking, the neckline is at 510, where the recent low is, and we could be heading there. Coincidentally, this is also where the current 200 moving average is sitting. Well, considering that SPY has already declined more than 4% from 565, and if it were to fall further from the current price of 540 to 510, that's another 5.5% drop. That's almost putting the broader market into the correction territory. Okay, I'm not saying it will happen, I'm just laying out the possible scenario. Just like my last video, I mentioned that if the bearish seasonal September thesis plays out, I would think minimally SPY will head towards the big gap between 544 and 548, and SPY did it. Alright, before we hit that neckline at 510, there's one important level to watch, which is 531. This is a resistance turned support level that happened in May-June period, where SPY had difficulty going above this level. But once it punched through this level, it went to all-time high. Just to add on, this is also where the critical 61.8 Fibonacci level is, so watch this level very closely this and next week. If it breaks, the odds of SPY falling towards 510 will increase. On the other hand, in terms of the upside, only one area to watch, and that is 549 to 551. This range is formed by the 50 moving average and the 23.6 Fibonacci level. The two occasions when SPY went above 551, it went further up to 560's range. So if SPY can somehow reclaim 551, then naturally the odds of it hitting 560's again is high. Otherwise, as long as SPY stays below this area, my view remains bearish for the month of September. Alright, jumping over to Apple. Like I shared last week, Apple's uptrend is stalling out, but we don't know whether is it the bulls taking a break or bears are taking over control. Well, Apple did fall last week, like many other stocks, but the decline isn't that bad. I think it could be investors are all waiting for Apple's event on the 9th of September. That event could shake things up for Apple. So what should we look out for on the chart? First of all, watch that 50 moving average at around 222. Apple has fallen briefly below it last week and did the same back in August. By falling below it only means it's slightly bearish. But if Apple stays below it for an extended period of time, then obviously it's quite bearish until it gets above it. One example is back in January and February 2024, Apple fell below the 50 moving average, tried to reclaim it, got rejected, and started its downward trend for the next 3 months. It only got above it in May 2024 with that huge gap up before embarking on a massive uptrend. Okay, if 222 gets breached, the next area to watch is around 205 to 210. Apple has to bounce from here if it gets here this or next week. Because if it doesn't, I think I have shared this for a few videos already, and that is, below this area, I don't see much support all the way to 195. For the upside, quite simple and straightforward. Apple needs to get above the 50 moving average as soon as possible. It will be even better if it can trade above 224 again. Between 224 and the low 230s range, it seems like a zone for Apple to build a base, or aka consolidation. Moving over to Tesla. Well, if you're an option trader, you should really love Tesla. Look at how Tesla opened last week at 210, rallied for 3 days and went as high as 235, and then it took only 1 day for it to fall back down to 210. This is why I love to trade it, as I profited $200 for some nice meals and coffee last week. By the way, this is a swing trade and is not covered in my options trading segment. Otherwise, this video will be super long. Anyway, last Friday's gigantic red candle looks crazy. I don't think you need me to tell you that's bearish. Just to add on to this bearish candlestick, the sell-off was supported by a higher than average volume. And also, despite the MACD having a bullish cross twice in the last 1 month, it struggled to break out from the MACD center line. That means bulls are lacking strength to push the stock price higher. Come this week, I think we can expect Tesla to retest that blue downtrend line at around 203. Okay, I would like to emphasize the importance of this level, this 203 level. Okay, maybe give and take a little bit, say 200 to 203 level. This is a very important area. This area is formed by the blue trend line, the 23.6 Fibonacci level, and the 200 moving average. If this triple support zone gets breached, I do think the odds of Tesla falling to 180's range is high. It may not happen in 1 week, but as long as Tesla starts trading below 200 and don't get above it quickly, it will likely grind towards 180's range. Okay, that's just my view and I could be wrong, and in case I am wrong, how do I know I am wrong? Again, watch that blue trend line. Remember the 3 R's? If Tesla did a classic textbook retrace, retest, and rebound off that trend line, then we can temporarily throw the earlier bearish thesis away. A rebound off the blue trend line will likely bring Tesla above 50 moving average at around 223. But of course, that will not bring Tesla out of the woods yet. We need Tesla to fill that gap between 235 to 245 and not get rejected. Then that will open the door towards the 250's range. Just to highlight, Tesla got rejected at the bottom of the gap last week. It couldn't even fill 10% of the gap. This again shows that bulls are lacking strength. Moving over to Google's chart. In my last video, I have shared that Google is looking bearish after that 3 black crows bearish candlestick pattern. I also highlighted a few other bearish signals and mentioned if MACD starts to curl down, we have a high probability to see Google hitting 150's range again. And Google did exactly what I shared. To add on to the bearish thesis, there is a bear flag formed on the chart, and Google broke down from the bear flag last week. To make things worse, it went below the 200 moving average and the recent low of 155. For this week, don't be surprised if Google drops towards the gap between 143 to 145 if the broader market continues its sell-off. Just to add, the DOJ's second antitrust trial against Google will begin on Monday, so be very careful if you wish to go long on Google now. In fact, I wouldn't recommend that. Better to watch and see. Anyway, if Google can't find support at the gap area, then I think we can say hello to 130's range. By the way, in case you're not aware, Google has fallen about 20% from its peak, and by theory, that's a crash in stock price already. This is the reason why I step in for both option trading and buying of Google shares. More on that later. Okay, in terms of the upside, Google needs to reclaim the 200 moving average quite quickly. I have shared previously that 200 moving average is a double-edged sword for Google. It can act as a strong support and also a strong resistance level. So the longer Google stays below it, the harder it will find itself in reclaiming this level. Let's give Google about 1 week maybe. If it doesn't go above the 200 moving average by the end of this week, the bearish trend could further worsen. But if it goes above it, it is still not out of the woods yet. We need Google to break free from 164 and 169 levels. These are the 2 levels that it failed to hold recently. Let's now move over to Meta's chart. Okay, for Meta, I will have to finally drop the inverse bullish head and shoulder pattern, because since Meta hit resistance at 540's range, it seems like the odds of the bearish double top pattern playing out is higher than the bullish pattern. Just like SPY not trying to scare you, if this bearish double top pattern plays out, Meta may head towards 440's range where the neckline is, but that's in theory. For that to materialize, first of all, Meta needs to break that critical 61.8 Fibonacci level at around 481. If this 481 level gets breached, we will then have a high chance of seeing Meta at 450's range where the next support level is. This is also where the 200 moving average sits right now, at 557 to be exact. After which then we can talk about the neckline at 440's range. As for the upside, two key levels to watch. The first one is 505. I shared this double support level in my last video, emphasizing how important it is, and that if Meta falls below it, there is then a very high probability that Meta will continue to grind below 500 level. And again, Meta did what I shared. So right now, Meta needs to reclaim 505 again to potentially reverse the trend. Note the word potentially. I will only call Meta slightly bullish if it can reclaim 520 and stays above it. By the way, in case you didn't follow my last video, 505 is formed by the 38.2 Fibonacci level and the 50 moving average. That is why I call it the double support level, but it has now turned into double resistance level. Let's now have a look at Microsoft's chart, which looks pretty bearish to me. That seems to be a bearish head and shoulder pattern formed on the chart, with the neckline at around 385. To add on, there are two more bearish signals. First of all, Microsoft closed below the 200 moving average. The last time round when it did so, it was back in March 2023. Secondly, the MACD just had a bearish cross last Friday. This is the reason why I did not step in to trade or buy Microsoft shares yet, because the bearish trend could potentially continue this week. If it does, the first target for the bears will be the support level at 395. If that breaks, then we could head towards the strong support level at 385. This is a very important level for the bulls to protect, so watch it like a hawk. If 385 gets breached, it means the head and shoulder pattern is playing out, and when that happens, not scaring you, by theory, it could go towards low 360 range at least. On the other hand, if Microsoft can bounce off either the 385 or reclaim the 200 moving average, then things wouldn't be too bearish. But for us to call it bullish, it has a long way to go, man. We will need Microsoft to go at least above 426 or perhaps even reclaim the important 61.8 Fibonacci level at 436. Honestly, I am not very optimistic that it will happen this month, but I stand corrected, of course. Finally, let's jump over to Nvidia. Nvidia has been falling like nobody's business, slicing through those support levels easily like they are tofu. Anyway, it's currently sitting at a very critical area which I shared last week, and that is this 100 to 102 level. It looks like the bulls are defending hard and defending well, but given the broader market being so bearish, it also looks vulnerable to me. Anyway, I wouldn't bother guessing or predicting whether this area will hold or not. I only care about what it brings if it holds, and also if it doesn't hold. Okay, so if this 100 to 102 area doesn't hold, I think Nvidia stands a high chance to drop towards the 200 moving average at around 89 to 90 area. This is also where the recent low is. This area is even more important than the 100 to 102 area. Reason being, ever since Nvidia went above 200 moving average in January 2023, it has not fallen below it. In fact, it didn't even go close to it. Which means this time round, if this moving average gets breached, I do think there is a very high probability that we will see low 80s range or perhaps even the 70s range. From there, I wouldn't be surprised if market makers bring it further down towards the gap between 68 and 74. As for the bullish thesis, okay, before that, could you spend 2 seconds to like this video if you found my weekly content useful? If possible, do drop a comment below as well. More engagement with and from the viewers can help to push the videos to more audience and grow this channel. At least that's what people say. Okay, for the bullish story, of course Nvidia has to hold on to the 100 to 102 area, but that is definitely not enough. We need Nvidia to reclaim the 50 moving average at around 119, but again, that's not enough still. Can you see that blue downtrend line? It has to go above it, or specifically go above the recent high of 131. Then we can say that Nvidia has reversed its short-term bearish trend, because above 131, it means Nvidia has stopped creating lower highs. Alright, let's now move over to the options trading section. Just one trade to update this week, which is this new cash secured put that I have sold on Google. The strike price is $145 and the contract will expire next month, 18 October. The reason why I sold this put option is quite simple. In fact, I have shared it last 2 weeks that I have been waiting for the opportunity to do so, and I also stated my criteria. You can check out my last video if you want. Anyway, the criteria is to wait for Google to hit the 200 moving average. So yup, like what others love to say, I am putting my money where my mouth is. Anyway, as shared earlier and also in my last video, the 200 moving average is a strong support level. Even if Google falls below the moving average a little bit, there are still some odds that it will bounce up. Furthermore, the RSI is approaching oversold, hence increasing the odds of a short-term bounce. So these are the reasons why I step in to sell a put, which is a slightly bullish move. But of course I could be wrong because this 200 moving average, like I said, can act as a double-edged sword. It's either Google bounces off this level nicely, or if this level breaks, Google can fall quite significantly. So remember what I always said, be prepared for the worst case scenario, and in this case, the worst thing could happen is that I will be forced to buy 100 shares of Google. With this in mind, I asked myself, at what price am I comfortable to snap up 100 shares of Google? And I am of the view that 145 isn't that bad. Furthermore, 143 to 145 is where the gap area is, which means it will offer some form of support. Sometimes market makers may bring the stock down to fill the gap before rebounding. If that happens, then my 145 strike price will not get breached. But if all else fails, I am okay to take 100 shares of Google's at 145 per share. Another alternative is to roll the contract before assignment. If you don't know what is rolling off option contract, do consider checking out my video link at the top. By the way, what you see on screen here is paper loss. The percentage will fluctuate a lot all the way till the expiration date. Sometimes it can swing 200 to 300%. It's perfectly normal. Okay, some thoughts to wrap up this video before you hear from me in 2 weeks' time. Well, I just wanted to reiterate that we are entering one of the most volatile periods and perhaps the most bearish month of the year for the US stock market. Historical trends are on the side of the bears. As you can see from this image, September has historically been the worst month of the year for S&P 500 as it clocked an average loss of -1% dating back to 1928. That's about 100 years ago. Wow. Here is another graph to show how bearish September can be. As we can see, the S&P 500 has declined about -2% on average in September over the last 10 years, making it the only month with negative returns. And if we were to look at the shorter time frame, the last 4 Septembers gave us a negative returns in S&P 500 ranging from -3.9% to -9%. Basically, in short, whichever chart or graph that you search for or whichever period you use, it's almost all pointing towards a bearish September. Just to add on, even the famous bull of the US stock market, Tom Lee, is looking at a 7% to 10% pullback between now and October, and he has asked investors to stay cautious. Okay, with so many bearish statistics, trends, news, analyst views, etc., should we panic? The answer is no, we shouldn't. The reason why I am sharing all this bearish information is not to scare you, it's not to make you panic, it's not to spread fear. In fact, it's the opposite. I am hoping by sharing this bearish information, it could calm you down a little bit. It sounds counterintuitive, right? What I mean is, by feeding you with all this bearish stuff, at least you are mentally prepared. At least you have heard it here first before the negative headline news take over the internet for the next few days or weeks and the market starts falling. For those viewers who have heard from me last week, you would have been given the heads up that September is a seasonal bearish month. You wouldn't then be too surprised by last week's sell-off. It's just September doing its September thing. So yep, you heard the bearish info from me last week. You are hearing it from me this week, but I won't be around next week to share more of such info with you. But I hope you will be fine. Remember a few weeks ago when this type of massive sell-off happened? It hurt a little bit, but we survived. So the latest sell-off may hurt our portfolios now, but we will be fine. And remember the action plan that I shared? If you don't know, go back to my last video and watch the end thoughts segment. Anyway, I stuck to my plan. I sold a put option and I also picked up shares last week, though it was only a little bit. To be specific, I stepped in for Google only. Well, some may think that could I have stepped in too early, considering that I know September has always been bearish. Why didn't I wait a little longer? Okay, here's the thing, no one can time the market, no one can time the bottom of this pullback. Remember the sell-off on 5th of August? Market rebounded one day after and went higher for the next 14 trading days. I record I only managed to step in a little bit on the sell-off day. Therefore, similarly, I am doing the same thing here. I am stepping in a tiny bit here to start the ball rolling, just in case I'm wrong about a bearish September, and in case this year's September doesn't follow those 100 years worth of data. When that happens, at least I have stepped in a little bit to ride the wave up. Furthermore, I have not been able to pick up Google shares since March this year, that's half a year ago. During this period, Google has shot up to 190 and came back down to 150's range. At the current range, I am already getting Google shares at about 20% discount. And if the market declines further and decides to give me more discount, I will be more aggressive in picking up more Google shares, as well as other stocks that are on my watch list. Anyway, a huge disclaimer, my own action plan is not financial advice to any viewers out there, right? Please do your own research. My intention is to heads up you on the potential bearish and volatile September in hope to calm your nerves such that you can draft out an action plan for yourself and then stick to it. Ignore the noise in the market. We will ride out this choppy period eventually. All that said, but if you really can't stomach the volatility and gets really affected by the multiple red days, you can also consider not logging on to your brokerage account this month. Come back again next month or the month after. You know, wake up when September ends. By the way, for me, I'm actually quite excited about a potential bearish and red month. Am I weird? What are your thoughts? Are you equally excited or weird as me? Let me know in the comment section below. With that, I will see you in the next video. Thank you.